All right, welcome back, everyone. Merry Christmas. Welcome to Lunch at the Market. We're going to dedicate this show to Devonte Christopher, who has a terrible Twitter name, Mr. Amazing. Oh, Mr. Amazing himself. Well, guess what? Mr. Amazing himself, I don't think actually even caught a single ball last night, and his offense didn't actually score a single touchdown. I guess he's not that amazing. So here's to you, Mr. Amazing himself, Mr. Devonte Christopher. Maybe that'll teach you not to put dumb comments on Twitter before you play one of the best teams in the country. All right, so now that we've done enough of offending all of the Utah football fans out there, which I'm actually a fan of Utah, I'm just not a fan of arrogant people who say dumb things in public forums like Twitter. Okay, so on to today's news that you need. Let's get you off to Christmas with a bang. Actually, not really a bang because nothing's really happening today. In fact, this is probably the most boring trading day of the year, and I don't actually know why we're even open today. We should be closed at 1 o'clock, but we're not. So here we are spending our Christmas Eve with you guys here on Lunch at the Market. We are spending our day buying puts and putting on callers. No, that does not refer to my orange shirt that matches my Boise State orange and blue hat today that I'm wearing to celebrate the victory last night. A caller is when you are long a put and short a stock. Sorry, long a put, short a call with your stock in the middle. Okay, so say you're long 100 shares of Bank of America. Actually, no, that's a bad example. Say you're long JP Morgan Chase. This is a good example because we did this today. You're long JP Morgan Chase. The stock trades around 42 and change. Yeah, 42.04. Okay, so we're long the 40 put and short the 45 call against it. This structure that protects you, right? So you get called away at 45. I mean, shoot, if the stock trades up $3, that's almost another 10%. By all means, have it. Okay, and then you're protected to the downside for about an equal move, down $2. Okay, this structure only costs 27 cents. It's going to expire in January, and that ought to get you through what could potentially be a sell-off. Okay, if earnings don't come in where they should be, you'll see J.P. Morgan back at $37, and your 27 cents will be, worth $3, which will be money well spent to be sure. Okay, so that's how a caller works. We call them low cost or no cost callers. In some cases, you can actually put them on, if you go wide enough on your strikes, you can actually put them on for no cost at all. In some cases, you can put them on and get a credit, but you're probably pretty far out of the money from where you're long the stock. So it's not really that helpful or that protective if you put them on for a cost. But we like a low cost caller. For instance, Solutia, we're long the stock and we are long 22 and a half puts and sold 25 calls against it. So here we are long the stock, trades about $20. We're long 22 and a half puts. So I guess actually the stock probably trades above that. I'll have to take a look at that. We're long Solutia, we're long the 22 and a half put and short the 25 call against it. It actually only cost us 12 cents to put on the position. 12 cents. So you're not paying a ton of money, so it's not a wasted hedge. Okay, here's your way out. If the stock goes up, then hopefully you get called away. Okay, so it's easy if the stock trades up. You just get called away at a higher value and you move on. If the stock trades down and you're actually, if the stock trades up, you can sell a put further above that. Okay, so here's our, I'm trying not to use my middle finger, right? If you're long the put below it and the stock trades up, you can go ahead and sell a closer to the money put against it that's likely to expire worthless. That helps you kind of mitigate the losses on your hedge if the stock trades up. Okay, obviously if it trades way up and it gets called away from you, it should be pretty easy to sell that put without worrying about it trading back down. Okay, let's say you do that. Let's say right now, right, you're looking at either just a straight put or this part of your collar, and the stock trades up, and then you short a put, okay, turning this basically into a short put spread, which, big surprise, I'm sure you never heard about that around here. And you're short a put spread, and then the stock trades back down. You can now just do our standard exit strategy, which is to roll down and out to the next month, okay? So rolling down means you're short a lower put spread, okay, and then rolling out means you move it out to the next month. So here, if you, right now we're long the 22 and a half, let's say the stock trades up to 25, and you sell the 24 put against it, okay, so you're short a 24 22.5 put. Then the stock trades back down to say 23. You're going to roll down to the 22.5 20 put spread and then roll out to the month of February. Okay, then as long as the stock doesn't trade below 22.5 now, then you're okay. This is going to expire worthless, and then you'll go back to selling calls against it until you finally get called away. Okay, so remember, a caller, you own a stock long, you're going to sell a put above it or sell a call above it and use the money you collect from the call to finance purchasing a protective put. Okay, if you just simply sell the call, then you run the risk of what happened with Cisco. We sold a call at $24 with the stock trading at $24, and then the stock dropped to $19, $5 lower than we were short a call. Okay, so my 65 cents that I took in for my 24 call in Cisco didn't really help insulate my $5 per share loss that we took. So honestly, it's just better to do that as a caller, especially if there's any kind of significant risk that you think the stock will trade down, or if there's a big earnings event coming up or whatever. Don't be afraid to be called away from your positions. You have to sell your stock someday. If you don't, you're gonna run the risk of what happened to GE. That $40 stock still hasn't seen $20 in years. Okay, JP Morgan, we did that for 27 cents. Solutia, we put the caller on for 12 cents. We are pretty much where the highs we were when Lehman Brothers collapsed. So, I think right now the risk is a little to the downside. Yesterday we talked about reducing your position size by either swapping out of stock and into longer dated calls, or by simply reducing some of your position by selling your big winners. Okay? Please, please, please always have cash on hand so that if the market goes the other way, you can take advantage. Otherwise, you're going to be forced to sell stock at prices you're not as comfortable with, or you're going to have to take losses on things. Okay? And just to make sure that we beat a dead horse, once again, Deckers flushed on the open, and we sold the January 2011 80-75 put spreads. I think this morning we got $1.40 for those suckers. So we've got a pretty big position going on in those short put spreads. I don't know, maybe it's our hubris from having Netflix go our way. But for now, the pattern remains flush on the open and then trade up the rest of the day. And eventually what will happen is all the weak hands will get shaken out of this. That means eventually you're going to replace weak or people that don't have conviction in the stock with people that do have conviction in the stock and want to own the stock. Obviously, with every seller, there's a buyer on the other side of that. Once you get enough willing buyers and all of the selling is exhausted, the only way for incremental buyers to come into the stock is to bid the stock higher. Okay? So it's called shaking out the weak hands. Good luck. We're gonna sit tight on this shakeout and see if we can't shake some more of those weak hands out of there, and then hopefully the stock will trade above $80 a share and 1 penny on options expiration in January. And if it does, then we'll be successful in our position. If not, we'll be rolling down and out to the next month, and then we'll try it again. Thanks again for joining us, everybody, today. Please have a Merry Christmas. Stay safe out there. Spend some time with family and enjoy the day off. Thanks for tuning in again today, and we will see you on Monday.